Yes, I went to Muhlenberg College. I was a history major, and I've written some books that nobody bought. But what I did really was try to leverage history because I can be like every other investor. I can allow my emotions to be my portfolio's worst enemy. So what I try to do every day is to teach myself to follow the rules, to understand the market. Next week, I'll be down at the Wharton School teaching a class on using stock market history as virtual Valium. So actually, by understanding stock market history can help calm your nerves, make you feel better about things. I actually said the other day that the person from whom I got the best bit of investment advice was Clint Eastwood. When he was playing Dirty Harry in the movie Magnum Force, he kept mumbling through grit teeth, "A man's got to know his limitations." So I was thinking, well, what are my limitations? And my ego will only allow me to admit to 3, and I promise not to leave the wrong finger out. But I mean, the first one is I have so much data at my disposal that I can be frozen by indecision. As a result, I have concluded that I am so indecisive that my favorite color is black. I'm also impatient. I mean, what do you expect? I worked in New York City for almost 30 years. So yes, I get upset if I miss a slot in a revolving door. If I buy a stock, I want it to go up right away. If I sell it, I want it to go down right away. And so I think it's very important for people to remember that. So yeah, emotions are also very important to realize because fear and greed tend to be the emotions that drive investors. I actually think it's just fear. Fear of losing money on the way down and fear of missing out on the way back up. So it's a constant tug of war between your internal emotions. So my feeling is, unless you have the ability to be a very disciplined investor, then what you need to do is extract your emotions by following rules or being a student of stock market history. And that's what I do. So you'll be seeing a lot of stock market history in here. Yes, I work for CFRA, which is an investment research firm. Standard & Poor's decided to get out of the business that it started in 1860. There really was a guy named Henry Varnum Poor who wrote research reports on railroads. The Poor's Advisory Services merged with the Standard Statistics Company in 1941, and were going to call themselves Poor Standards. But then, thank you, you get a star back there. But decided Standard & Poor's would be a better name. But I guess because profit margins are so narrow for such a people-intensive business that they decided to sell the equity research department and sold it to CFRA, which stands for the Center for Financial Research and Analysis. So it's the same people doing the same job, we're just wearing a different uniform. So I've been, in a sense, with this organization now for 35 years. Is that a felony or a misdemeanor? Anyway. So you will see a lot of history in there, but obviously we do a lot of fundamental research. I like to say that fundamentals tell you what, but technicals tell you when and how far. History might not repeat, but it frequently rhymes, but I also add, but like the singer of the national anthem, sometimes it forgets the words. So that's why you need to overlay history with our economic outlooks, our fundamental forecasts, technical projections, in a sense, a whole mulligatawny soup, if you will, of indicators to help decide what is likely to happen. Now, I'm a Pollyanna at heart. When life gives me lemons, I make whiskey sours. So I usually like to start out by talking about good things. What happened last year? Last year, you can see that the S&P 500 was up 24.2%. All sizes, all styles, and a majority of sectors were in positive territory. And of the 153 sub-industries, almost 70% were in positive territory in 2023. So right now, people are probably thinking, oh, thanks, Sam, for telling me what I missed out on. Well, actually, history told you that 2023 was going to be a good year. Let's face it, markets go up and down. However, historically, the market tends to rise very frequently after it fell the year before. All year since World War II, the market was up nearly 9%. That's All years meaning following good years, following bad years, but all years. Well, after down years, the market actually rose 81% of the time and was up 14.2. So actually, more times than not, the market does very well after a down year. Also, if you get a confirmation early in the new year, such as, how many people here have heard the phrase, as goes January, so goes the year? Okay, so as goes January, so goes the year. The market was up in January following a down year, then the full calendar year was higher 92% of the time since World War II. And the average gain was more than 20%. Add one more indicator, meaning if the market in the first quarter of a year did not break below the prior December's low, that full year was never negative, and the average gain was more than 25%. Gee, that sounds like exactly what happened last year. So now people are saying, okay, well, what are some of the indicators telling us for the coming year, meaning 2024? Well, we've heard of indicators such as the Santa Claus rally, first 5 days, January barometer, but here we are, an election year with a positive January. Whenever that has happened since World War II, the market was up for the full year 100% of the time. And the average price change was a little more than 15.5%. Not a guarantee, even though it was 100%, it's not a guarantee. It just says that, hey, this was a pretty good indicator. So an encouraging statistic as to what might happen in 2024. But obviously, we're going to need to see more data that makes us feel comfortable for the entire year. But I would tend to say that's a pretty good start. So in a sense, allowing the market to let you sort of calm your nerves about what might happen, because by the end of December of this year, chances are the market will be higher, and substantially so. We've also had new highs. This market set a new high, its first new high on January 19th of this year. We've had low teens number of new highs in both January and February. Whenever we have had new highs in January and February, so after all-time highs in Jan and February, instead of the average price change going back, this really is going back to 1954, because that was the first time we hit a new all-time high after peaking in 1929. So we had 25 years of struggling back to where we were in September of 1929. We finally made it in 1954, but since then, whenever we had a new high in January and February, the market gained an average of 15.8% versus the average 9.2% for each year, going back to 1954. And I'm like Pavlov's dog. I want to get fed frequently, so I don't want just an average return. I want to know what's the batting average, what's the frequency with which I will not be disappointed. Well, average frequency of advance is normally around 73%. Well, after new highs, it's more like 88%. Yes, there were a couple of times in which we did experience a decline for the full year, but by having such a good start to the year, then we end up, on chances are, having a very strong full year. And this chart is different than what's in your book, only because what's in your book are the numbers. I am a numbers nerd, but at least I'm an extroverted nerd, which means I'll look at your shoes when I'm talking to you. But I figured a bar chart would be a better way of displaying that. So that's why this is different than what is in your book, but the numbers are exactly the same. So yes, we actually have a fairly high wall of worry that investors are dealing with these days. We know that in 2023, a majority of the gains for the S&P 500 came from those 7 stocks that they call the Magnificent Seven. Now they're worried that the Mag 7 will become the Lag 7. You know, what if we don't get broadening of this advance in the overall market? That might not be a good sign. We didn't have a Santa Claus rally. Large cap valuations, they're looking pretty expensive, 25% premium to their average PE over the last 20 years. So yeah, you could say that large caps are expensive. Consumers are getting a little more cautious, as we've seen with recent retail sales numbers. rising debt levels, the Fed sticking to its higher for longer mantra, and still there is a risk of recession. I think that risk is diminishing over time, but there still is the risk of recession. And what about the potential expansion of tensions in the Middle East? What about Ukraine, et cetera? But as you can see, this list is quite a bit shorter than those things that are of encouraging nature. And I'm going to go through a majority of these factors, which basically say why I feel fairly optimistic about the year ahead. So with that, people tend to say, well, Sam, tell me, what is the market going to do this year? And I say, well, I can answer that in a very simple riddle. What do you get when you cross an elephant with a rhinoceros? Elephino. I need you in the back to groan. All right, you knew the punchline. All right, thank you. So what this chart shows is that we tend to have a pretty good year. If somebody says exactly what kind of a year would it be, well, it ends up being a good year as compared with great years. So you saw the chart before that says the market goes up every year about 8.9%. Well, actually, that number goes down if you're only looking at years like if last year was higher, what happens this year? Well, on average, the year following an up year is up only 6.9%. And the frequency of advance is a little less than 70%. Yet, if that positive, or if that year follows a year that is higher by 20% or more, then investors say, oh, well, then I'm not going to push the market up by less than 7%. It's going to go up by 10% on average. And its frequency of advance is improved by more than 10 percentage points. So basically, don't fear a strong year, because one strong year sort of acts as a running start for the next year. And so you end up with a pretty good year. So sorry to hit you with another bad riddle, but what's the difference between an all-weather radial tire and a 20% total return? Well, one's a good year, the other's a great year. So think of good year and so forth. And that's the kind of return we could see this year, because good years tend to follow great years. We are also in a interesting chart. We are also in a favorable seasonal period for the stock market. Who here has heard the phrase, sell in May and go away? Okay, who has not heard that phrase? And then finally, who does not like to raise their hand? Okay, you're honest. Well, looking at these 12 rolling 6-month periods, we find that the worst 6-month period on average since World War II was a gain of only 1.6%. So on average, in that 6-month period from May through October, the market has gained just a little more than 1.5 points. Okay, what is the best 6-month period? Traditionally, November through April, up 6.6%. And this November through April tends to then beat the May through October period about 3 out of every 4 years. So not only is it better on an average price change basis, but also a frequency of advance basis. So we are in a good seasonal period for the overall stock market. This is also an election year. And it's an election year of a first-term president. Going back to World War II, how does the market typically perform in the election year for a first-term president? Whether that president is reelected or replaced doesn't matter. But the average total return was 15.5%. And surprise, surprise, frequency of advance was 100% of the time. Now, are there any recovering engineers in the room? I say that because engineers frequently like to say, well, unless you have 60 or more observations, it's not statistically significant. So obviously, since we have not had 60 presidents, at least first-term presidents, since World War II, one might say this is not statistically significant. But again, it can be very reassuring for investors based on the frequency of the advance along with the average total return. Also, we are in the second year of this bull market. And as you can see, a majority of bull markets going back to World War II were able to celebrate their second birthday, with the average gain being 12.5%. It was really the third year in which we have to worry, because we lost 2, 3 bull markets in the third year, and then 2 more posted negative or very weak returns. So the third year is the most challenging. So I would tend to say that 2025 is likely to be a challenging year, not necessarily 2024. So again, we are in a fairly favorable period for the market. I also like to say that investors are no better than hyperactive first graders playing musical chairs, always trying to out-anticipate the other as to when the music will stop. So, knowing that, not surprising that investors tend to buy into the market when they know that interest rate increases have ended and that sooner or later the Fed will start to cut interest rates. I go back to 1989 because prior to that, the Fed never told us what they did with Fed funds. We had to sort of figure that out with what was called Fed watchers. Yes, they told us about discount rate changes, but they usually happen well after the Fed funds changes. But Alan Greenspan, in an attempt to add transparency, he started saying we're going to be raising, lowering the Fed funds rate. So going back to 1989, there have been 6 periods in which, this is the 7th, in which we had a pause period between the last rate hike and the first rate cut. And in 5 of those 6 periods, the market moved higher with an average gain of a little more than 14% for the S&P 500. And small cap stocks, looking at either the Russell 2000 or the S&P small cap 600, the gain was pretty good at 9.5%. So only because we were still in the midst of the tech bubble bursting did we end up with a decline. But one of the worries that people have today is, hey, the Magnificent Seven, it's just 7 stocks. We need a broadening out of this market advance. Well, actually, the market advance has been pretty broad. This is not your EKG diagram, but it does represent what percentage of the 153 sub-industries in the S&P 1500, that's the large cap 500, mid cap 400, and small cap 600, what percentage of those sub-industries are trading above both their 40-week or 200-day moving average or their 10-week or 50-day moving average? So if these indices are above both the shorter and longer term moving averages, at 63%, the average is 48. We worry about being overbought at 70%, which we're not there. And we take heart that if we get down to 5%, we're pretty close to a bottom. I would tend to say that we're doing pretty well because we're in the upper area of the range. We're not necessarily overbought, but at the same time, we have an awful lot of these groups that are participating in this market advance, and that augurs well for the future. Also, when you look to fundamentals, what are earnings going to be doing? Because that's really what drives stock prices. It's earnings and interest rates when you then come up with intrinsic value calculations. What is this stock worth a year from now, 5 years from now, 10 years from now? Well, these are the sectors within the S&P 500, mid-cap 400, small-cap 600. What is the percent growth rate in 2024? So not bad, 9% for large caps, 15% for small caps. But of interest is, are they cheap or are they expensive? If you look to the S&P small cap 600, it's trading at it's like you're going to Macy's. Well, this suit is marked off 14% in a sense for small caps. So against its own PE ratio over the last 20 years, it's trading at a 14% discount. It's on sale. If you compare it to the S&P 500, it's even more attractively valued at a 35% discount. So from a relative PE perspective, small and mid-cap stocks look fairly attractive. However, as I had said before, fundamentals will tell you what, but technicals tell you when and how far. And right now, technicals are not saying that small caps are ready to break out. And I think the reason for that is investors are still a little bit worried because the Fed is likely to be slower to lower interest rates. So we think that they're going to start cutting interest rates in June, not in March, not in May, but in June. And they will not be as aggressive with their rate cuts in 2024. We think it'll be one 25 basis point cut in the second quarter, another in the third, and a final in the fourth quarter. So 3/4 of a percentage point reduction by the end of this year. So I think that's what investors are a little worried about. What if the Fed doesn't cut at all in the first half of this year, but waits until the second half? That possibly increases the likelihood of recession, because if things are too tight for too long, and we know that the mid and the small cap stocks take it on the chin much more than large caps in a recessionary environment. So I think that's probably one reason why the small and mid caps have not taken off, even though they are so attractively priced. This busy chart is more economic in nature, talking about GDP, unemployment rates, retail sales, inflation, and so forth. And you can see, really there's no red ink here. I usually highlight things that go down in red ink. We don't see a recession this year or next. Of course, the cynic in me says, when has an economist ever forecast a recession? But in terms of GDP growth expectations, we're expecting to remain above 2% or at around 2%. These numbers were revised just the other day, so around 2%. Unemployment will come out around 3.8 this year and only go up to about 4.1%. So the employment numbers are likely to remain as a good support for this overall economy. Inflation will not be at the Fed's target by the end of this year, but we think will be by the end of next year. We will likely see Fed funds rates come down with more rate cuts going into 2025. The 10-year note we think will ease a bit. The dollar will remain slightly firm, and oil prices, who knows what's going to happen with them? They change all the time. But our belief is that they will be firming as the economy continues to improve, and we possibly get an improvement in global economic growth. Let me ask you a question. Have you ever asked yourself in the beginning of a new year, should I buy last year's winners or should I buy last year's losers? Anybody ask themselves that question? I don't hear anybody nodding their head. One gentleman was kind enough to do so. So the question is, should I buy last year's winners or last year's losers? Well, the answer is, that depends. Was last year a down year or an up year? If last year was a down year, you want to buy last year's losers, because remember, I showed you that after a down year, the market is up 14%, not 9%, and it's higher 81, 82% of the time, not the 72% of the time. So traditionally, the market does very well in the year after a decline. Also, what we find is that those losers are the ones that investors tend to rotate back into. I like to say that they rotate from first to worst, or in New York, it's from foist to hoist. But basically what it means is that the best performing sectors in a down year are going to be consumer staples, healthcare, utilities. Not surprisingly, when the going gets tough, the tough go eating, smoking, and drinking. And if they overdo it, they have to go to the doctor. So those are the sectors that you gravitate toward during challenging periods in the market. Well, once the market has gone through that negative return in one calendar year, they get out of the best performing staples, healthcare, utilities, and into those groups that were beaten up the most because they have the greatest upside potential. That's why communication services, consumer discretionary, and tech, the three worst performing sectors in 22, were the three best performers in 2023, up an average of 50% for all three on average. So what this shows is that going back to 1991, because that's as far back as S&P has sector level data, the market was up on average 9.9% every year. Frequency of advance was 73%. Well, if you bought the three worst performers following a down year, and then the three best performers following an up year, I call that the alternate three sector strategy. You ended up with a 12.3% annual return versus 99. This portfolio went up 82% of the time versus 73%, and it beat the market 7 out of every 10 years. Well, let's dig a little bit deeper. Instead of just owning three sectors, what if I own the best and the worst 10 sub-industries from the year before? Well, alternating among the 10 best and worst sub-industries, your average return was 18%. You saw this portfolio rise 76% of the time and beat the market 73% of the time. Not a guarantee, but it's something that you would have to monitor very closely. But it does basically answer the question: should I buy last year's winners or last year's losers? And the answer is that depends. What happened last year, and that'll give you an idea. So for this year, meaning 2024, the best performers in 2023 were communication services, consumer discretionary tech, with honorable mention for financials, and they're the ones that we have an overweight recommendation on right now. And then these were the 10 sub-industries that did the best last year, and many of them, home buildings, semiconductors, application software, system software, are still doing very, very nicely. So we'll have to wait till the end of the year to see whether this strategy holds true once again. So in terms of just talking about the market, looking at history, looking at technicals, looking at fundamentals, yes, I think that 2024 could be a good year. My year-end target is 5,200 for the S&P 500. So a high single-digit price appreciation. And as I said, history says that it's likely to be a good year following a great year. Earnings are expected to be improving. We're sidestepping a recession. We don't think that overseas offers a very attractive alternative to U.S. equities. So also with it being an election year, that chances are it's going to be a fairly good year. So now the question is, well, you just started mentioning about the election. So let me ask you, how many people think that the market does best under a Republican president? All right, a few hands. You ever notice the Lone Ranger, when he done the crooked guy said, all right, put your hands up here. Well, he did this. I mean, my hands would be up here. His were always. So I saw a lot of Lone Rangers over here. I think Republicans. All right, so I guess the remainder of you think that the market does best under Democratic presidents. All right, survey says 11.5% was the average return in the S&P 500 since World War II during Democratic administration versus 7.1% for Republican presidencies. Now, somebody might say, well, wait a minute, Sam. But it's Congress that controls the purse strings. So shouldn't we really be looking at who controls the House of Representatives in order to make that decision? All right, well, what's interesting is that if you look at who controls the House of Representatives, the returns are almost reversed, that the market does better under a Republican-controlled House, up 10.5% on average, versus a Democratically controlled House of Representatives. So the moral of this story is you can use data to support any decision you want. So look hard enough and you can find statistics that will support whatever it is you want to say. So if you want to talk about parties and the market, you can do so with the presidency, with the House of Representatives. When quite frankly, the market has done fairly well under most presidents going back to World War II. Best return was under Bill Clinton at 16.5. Second best was under Trump, 12.1. The two worst were under Nixon and Bush, 43. But in general, you've had pretty good returns on average for these different administrations going back in time. What is interesting is if you say, well, let's look at it based on both the presidency and the House of Representatives and just Congress in general. So I grouped them unified government, meaning both the president and Congress are the same party, whether it's Democrat or Republican. A unified Congress, meaning that you had both houses of Congress being from one party and then the presidency of the other party. And then a split Congress, which is what we have right now. It seems that a lot of people want gridlock in Washington. They say gridlock is good. And I can only say that the reason why they might say that is because there is this old adage floating about that says, if the opposite of pro is con, then the opposite of progress is Congress. But have you also heard people say, oh no, the Fed thinks that they are neutral, but they really are there to support whatever government put them into power? Have you heard that? Again, anyone in the back want to nod their head? Okay. Well, what I did was I went back again to the early 90s, looking at Fed funds data, and found that every election year since 92, except for 212 or 2012, saw the Fed either raise or lower rates in that election year. So yeah, more times than not, they do make changes to monetary policy. And a lot of these changes did occur in September or October of that election year. So if the Fed says, you know what, we need to make changes to monetary policy to stick to our dual mandate of full employment and low inflation, they're going to do it. And they have proven that they will do it. That will either help or hurt the president if that's what they felt, if that what investors felt was their overall goal. Also, every Republican president since at least McKinley, meaning I didn't go back any further than McKinley, but every Republican president since McKinley had a recession start in their first term in office. Presidents with the most recessions, here it's equally divided. You know, we had Wilson with 3, Eisenhower with 3, both Roosevelt's with 2, and Bush 43 with 2. So recessions have occurred with both Democrat and Republican presidents. The only thing of interest is, and you'll like this, is under Kennedy, we had no recession, along with Johnson and Clinton, Obama, and Biden so far. Now, what can the market do to help you to guess who will end up being elected president? Well, one thing is take a look at the stock market's performance from July 31 of this year until October 31 of this election year. If the market goes up, the president will get reelected. If the market goes down, the candidate or the party will be replaced. The down return for the market has been the most consistent, being correct every time but one, so for a batting average of 89%. I don't think that the market thought that Adlai Stevenson was going to dethrone Dwight Eisenhower. What actually happened was in October of 1956, you had 2 major geopolitical events. You had Gamal Nasser, who was the president of Egypt, seize control of the Suez Canal that prompted a military response by Britain and France. You also had the Hungarian uprising that was then squelched when Soviet tanks rolled into Budapest. So Hungary, the Suez Canal tragedies were what really spooked the market, and we had a sharp decline in October when those things occurred. Interesting, but the market declined 2.2% in 2016. The indicator said, you know what, Trump will therefore likely unseat the Democrats who were in power, and sure enough, he did. 2020, the market declined ever so slightly, but it was enough of a margin, similar to the number of votes that separated the 2 candidates, to show that a change in administration was likely. So we'll have to wait and see what happens this time around. If the market goes up, then it's likely that the current administration will be re-elected. If the market goes down, the current administration will be replaced. So that's something you can look forward to. Finally, the question frequently is, well, which sectors do the best during election years? And you can say that, okay, we've had 8 election years since 1992, again, because that's as far back as S&P has sector level data. Of those 8, consumer discretionary, communication services, energy, financials, and industrials outperformed the market 5 of 8 times. We had materials, utilities outperformed 4 of 8 times, staple, healthcare, tech, 3 of 8 times. So, you know, okay statistics for those 5 of 8, but not so great for the other ones. It's a coin toss. So I would basically say what drives the market from a sector perspective really are what are the proposals that are out there, and therefore what is the likely policy change that could take place. Could it end up being like 1993 when healthcare was under attack, and putting everybody on Medicare? Could it be problems with energy? Could it be defense? Whatever. So just pay attention to what the platforms are of the presidential candidates, and that would give you a better idea as to what will likely happen to those sectors this year.